All right, so today we're going to be taking a look at the tax-free savings account. You know it better as the TFSA. This is a registered account specifically for Canadian residents, and it's a pretty significant way to grow those savings, without having to worry about the tax man. Essentially, it's a way for you to accumulate wealth and not have it reduced by taxes. Now, this system, it actually came into effect in Canada back in 2009, and it really came about as an alternative to the become more well-known, more established registered retirement savings plan, the RRSP. If you're finding this helpful, be sure to like and subscribe. So at its core, a TFSA really allows your savings to just grow. And the beauty of it is there are no tax implications. So how it works is Canadian residents, anybody 18 and over, can contribute money that they've already paid taxes out of. We call this after-tax dollars. And once this money is in your TFSA, you can then invest it. And any growth that happens within that account, well, you don't have to pay taxes on that, and maybe even better, when you decide to take that money out of your TFSA, those withdrawals are also completely tax-free. See, you've got the tax-free growth and the tax-free withdrawal, and that's really the heart of why TFSAs are so attractive. Now, when it comes to what you can actually keep in a TFSA, well, you've got quite a bit of flexibility. You can hold stocks, and these are basically shares of ownership in publicly traded companies. Then you've got bonds, which are essentially loans you're giving to governments or corporations. And then there are guaranteed investment certificates, or GICs, as they're often called. Those offer a fixed return, over a set period of time. And for those who really want to diversify, you can also hold mutual funds and exchange-traded funds. Mutual funds pool money from a bunch of different investors, while ETFs often trade like stocks, but they represent a whole basket of investments. So you've got options. Now, of course, the Government of Canada, they kind of manage this whole TFSA framework. They set what's called an annual maximum contribution limit. That's the total amount any resident can put into their TFSA in a year. And it's important to note that this limit, this maximum, it hasn't always been the same. Since it was introduced back in 2009, it's been adjusted over the years. But one really nice thing about TFSAs is what's called the carry forward. So let's say you don't contribute the full amount that you're allowed to in 1 year. Well, you don't lose that space. That unused portion can be added to your limit in the following years. It gives you some breathing room, some flexibility in how you save over time. Now, I think it's only natural to want to compare the TFSA to other savings plans, particularly that RRSP we talked about. I mean, they're both registered, right? But there are some fundamental differences. We've already talked about how contributions to a TFSA are made with after-tax dollars. With an RRSP, though, it's a bit different. You're using pre-tax earnings for your contribution. And that can actually lead to a tax deduction in the year you make that contribution. Another big difference is how withdrawals are treated. Remember, money you take out of a TFSA, it's entirely tax-free. But when you withdraw from an RRSP, or when you hit the retirement income phase and you're dealing with a registered retirement income plan, or RRIF, well, those withdrawals are considered taxable income. So both of them give you tax advantages, but when you get that benefit, that's really different. And then there's the question of how much you can contribute each year. For TFSAs, there's a set maximum, and the government decides that amount. It's usually the same for everyone. With RRSPs, though, your annual maximum is tied to your income from the previous year, so it's calculated, although there is an upper limit to that calculation. Finally, we need to consider old age security. Now, withdrawals from RRSPs or RRIS, but can actually lead to something called a clawback. Depending on your total taxable income in retirement, you might lose a chunk of your OAS benefits. But here's the key difference. Withdrawals from a TFSA, they don't have that effect. They won't affect your OAS benefits at all. But it's a pretty big deal when you're trying to figure out your retirement income. But it's not just RSPs we need to compare TFSAs to. We should also look at how they stack up against non-registered investment accounts. Both are funded with after-tax dollars, that's true, but the way earnings are taxed is where things get interesting. In a non-registered account, any income you make, like interest, dividends, or capital gains, you got to pay taxes on that. And you pay those taxes in the year you earn that income. With the TFSA, well, we've already talked about this, but your earnings aren't taxed. Not now, not later, never. The other big difference is those contribution limits. Remember, TFSAs have that specific maximum set by the government each year. Non-registered accounts, not so much. There's no limit to how much you can invest. You can put in as much as you can manage. And, there are actually some limitations on what types of investments you can hold in a TFSA compared to a non-registered account, that is. For example, you can't hold things like futures contracts in a TFSA or an RRSP. They're considered a bit too complex, a bit too unconventional, but some non-registered accounts might allow them. So who can open a TFSA? Well, you need to be a Canadian resident first and foremost, and we have to be at least 18 years old. You don't actually need to be a citizen, though. If you're a here's an interesting one. Even if you're not living in Canada, you can still have a TFSA. As long as you've got a valid social insurance number or SIM, you can hold it and you can even contribute to it. But this is important. If you put money into the account while you're not a resident, you're going to be hit with a 1% monthly tax. On the flip side, if you're a US citizen who's not living in Canada and doesn't have a SIN, well, you can't open a TFSA. So those are the rules. Now, if we take a quick trip down memory lane and look at TFSA contribution since they first came out in 2009, well, they definitely bounced around a bit. We've seen them as well as $5,000 and as high as $10,000 in some years. To be absolutely sure you've got the latest information, though, your best bet is to check the Government of Canada website. They have a whole section dedicated to TFSAs, so you can find the most up-to-date numbers for your financial planning. Now, the big question, should you go with a TFSA or an RRSP? Well, there's no easy answer there. It really comes down to your own personal situation, your own goals. Think about your income level now when you're making these contributions, and also what you think your income will be when you want to start taking money out in the future. Can you afford to invest without getting that immediate tax break you get with an RRSP? That's another question to ask yourself. And don't forget about that potential OAS clawback we talked about. If you take out a lot of money from your RRSP in retirement, you might lose some of those OAS benefits. These are all things you really need to weigh carefully. I mean, making the right choice for your financial future, that's important. So we've taken a pretty detailed look at the TFSA. Hopefully, you've got a much clearer understanding of what it is, how it works, and how it compares to other investment accounts you might be considering. If you're in Canada, it's definitely something to think about. If you found this helpful, don't forget to like and subscribe for more insights like this. So long for now. Farewell.